Hi, folks. This is Sean Hyman from the Logical Investor newsletter, and just wanted to point out that the monthly newsletter is out as of last night. It talks about my upcoming shift to my own site in the future, and a little bit about that, at least as much or as little as I know about it right now, and because all that's in the works and being worked on. And so the release of the monthly newsletter, a new pick, which is PPLT, which is also one that you may hold in former portfolios, and why you can still add to it if you do own it in previous portfolios. I spelled all that out in the newsletter. And then also I just released a profit taking sell signal on IBM. All the reasons why here, with the typical charts and graphs and stuff like that to show you what I'm looking at and why I believe it is time to sell. So in the portfolio, we sold at about 152. You may have sold a little higher, a little lower than that. So far, I've seen ranges of profits anywhere from like 7 or 8% up to 31%. Part of that depends on whether you bought the stock with me just in LI, or whether you had previously held it in UWR. There's actually advantages to both. If you bought it in the Logical Investor, your gain on your percentage return is likely larger. If you held it for the 2.5 years that we held it in the Ultimate Wealth Report, then your gain on appreciation, you might think, is smaller at 7, 8, 9, 10, 12%, but it's got roughly around a 4% dividend yield each of those years. So when you consider 2.5 years of dividends added into your annualized gain, that makes a huge difference. Some people forget to account for the dividends, and they just look at their entry prices and their average break even and their sell price. But when you hold a high dividend yielder for multiple years, that dividend really makes a big difference in your overall return. And it's one reason why I like finding nice dividend yielders when I can find them. But the nice dividend is like the icing on the cake, but not the cake. So we aren't dividend led, because if you start and search for just dividend yield and invest according to dividend yield, you're going to have a sucky portfolio, I can tell you that. And because you're going to lose more in general in depreciation than you're going to gain in dividend. So, and I get that a lot of my crowd is retired and fixed income and would like to have dividend income, and we do get dividend income along the way for the time periods that we hold it, but we don't put dividend in the driver's seat. It's back there in the passenger seat, in the back seat, for that reason, because I'm not willing to gain 4% dividend yield and per year and hold it for 2 years and get 8% in dividends, yet lose 20 or 30% in depreciation because I bought something overvalued. So if the stock is fundamentally sound and fundamentally of value, I'm fine with it if it goes down from there and it allows me to average down and build a bigger percentage, which is going to give me more dividends in dollars in the end anyway. But a lot of people put dividends in the driver's seat. They look at it, firstly, it's a novice mistake, and they go, oh, this stock yields 4%, this stock yields 5%. I'm gonna buy it. And the problem is they don't know that it's 20 or 30% overvalued. So just when it comes back to fair value, it's down 30%. Well, how many years of 4% dividend yield is it going to take you to get back to break even off of dividends filling in the hole from that 30% overvaluation that you bought the stock at? So that's why dividends have to be in the back seat and not in the front driver's seat. And I'm a huge fan of dividends. Anytime I can find something that meets all my criteria and it's a big fat dividend, that's a bonus. I love it. I love making two ways that we can make money through appreciation and dividends over just one way we can make money. But with that said, I also don't love it so much that I'm willing to take unnecessary risks to obtain it. Otherwise, you can make pennies and lose dollars by putting dividends strictly in the driver's seat. So with that said, new buy alert and PPLT, it's in the newsletter, which since the sell alert just got published, it moves it over to here on the site. So make sure you realize that the Logical Investor newsletter, July 2019. So it's prominently titled there, and then take profits on IBM immediately. In the newsletter, I talk about Platinum, why it's so valuable. I also start off talking about why I'm switching over to my own site and why I need to do that. Here's a very important part on how you can help me in this process. And again, I want to make sure that you're aware of me switching. So now I've mentioned it in 2 weekly videos in my monthly newsletter. So I'm trying to give you every chance to realize and be aware that there's a shift coming. And then I'll start talking about Platinum and how it's breaking an 8-year-long downtrend line on actual Platinum itself, not on PPLT, but just looking at the underlying asset. In other words, that's what this chart is. And PPL tracks Platinum. Then I use a visual that talks about all the uses of Platinum, of why we need it industrially in America, that it's not just only a precious metal, but it's industrial metal that we have to have it. So therefore it cannot go to zero. And that's why I'm okay if somebody allocates more money to it, because we're buying it at such a discount relative to gold, and it's cheaper than it's ever been in the last 40 years relative to that ratio. And I talk about that platinum to gold ratio here, and what the price has done. Be sure not to miss and skim the monthly newsletter. Some of you are asking questions that are in the newsletter, and some of you are even missing questions that I've literally got bolded. So it tells me some of you are skimming. And again, it's not that, because I write something, everything's golden and every word should be lapped up. It's not an ego thing. It's just that I don't want you to miss anything that's vitally important. And I don't write for fluff. I write, for what's vitally important. So if you're skimming, you're missing some of what you're paying for. You're missing part of your education, and I just don't want that for you, because I want you to maximize what you're paying for. I talk about other potential catalysts that can help platinum, like the dollar going down, commodities going up and being in a pullback right now, and many other different things. So I list a number of different things. Your portfolio's at the bottom. We bought into PPLT in this portfolio at 80.27. I try not to take the lows or the highs, but something kind of out of the middle, and something after the price of the security at hand's been trading for a while that day. And so to give the most realistic price, not just some buying the low of the day kind of a price to inflate our returns or any kind of stuff like that. I want something very, very realistic. It's also why when we exit stocks, I like to ask you what your returns are, because it allows me to post an average return in there, so that it gives a realistic return of what many people actually made on the investment with their averaging downs and so forth. So I don't take the very highest, I don't take the very lowest return. I take some of the ones in the middle, because that's where the bulk of people profited. So that's why I ask you to post your returns on what you made. And then our IBM sale, of course, is not in here, because the monthly newsletter was released before this alert came out. I just released the newsletter last night, and the IBM sell alert came out today, as IBM surged to new highs, and it just looks like a huge risk of correction for IBM. Um, it doesn't mean it's guaranteed that it has to go down. And it's just extended. You're over bought on your RSI. You've got a MACD that's a sell signal and sloping downward a bit. You've got on the weekly, just update that chart. It's in its top Bollinger Band on the weekly, and it's near one on the daily. It's extended a little bit from its 200-week moving average, but the one that normally stays even closer to is the 50-week moving average, and it's far from that. And many times when it gets far from that 50-week, it has a snapback, whether it would be above or below it. And so, of course, you've got so RSI is overbought on both the weekly and the daily. You've got the MACD histogram that is slumping lower. So there's a lot of hints that the probabilities of a sizable percentage recoil is around the corner. And that does not mean that it has to go down. It means there's a high statistical probability of that happening, and that's what the technicals are telling us. We can't foretell the future. Nobody can. But we can tell what our odds, the statistics, the probabilities are behind something happening, and the odds are for a pullback. And again, we don't cry over spilt milk if we take profits today and this thing goes up some more. But why? Because a novice will always say, well, it went from 152 to 155. I should have stayed in. So that sounds nice, but you didn't know the future. Okay, what if? Because it just could have easily gone from 152 to 146, and would you still be saying I should be in if it went from 152 to 146? Yet you don't know the future of whether it will do one or the other, but you do know when things get stretched away from major moving averages, when indicators are diverging or overbought, especially on weekly time frames, and Bollinger Bands are getting hit on weekly time frames and stuff like that, that there is an enormous chance of a sizable pullback. So that's all we know is a chance, not a guarantee. But that's as big of a indication as I need for us to lock in a guaranteed profit of what we know for sure that we have today, because we don't know what tomorrow will hold. So, therefore, I never assume that when we sell, we call a top, even though it's happened a time or two here or there. But that's honestly, that's accidentally. Nobody can say I'm so good that we called a top. Just like when we buy, we don't assume that we bought a bottom either. So, typically when you sell, it usually does you good to quit looking at that chart because if it goes up further from that, then it frustrates you, and what is frustration? It is an emotion. And so what does that mean? It's taking you from logically investing over to emotionally investing. So, I had somebody email me, talking about how some of the momentum stocks had done, and basically indicating, maybe we should have been in some of those, and they've done well, and this and that, and that's really an emotional thing, more than a logical thing, because you're buying high to hopefully sell higher. You're buying overvaluation in hopes to sell even more overvaluation. You're buying bubbles. You're buying momentum. And the novice thought is, yeah, well, I'll know when to get out. And I've been watching markets for 25 to 30 years now, so most of my life, literally ever since I was almost a kid. And I say that like 1920, I was interested in markets. I probably started watching them closer when I was like 21 or so, 21 to 23, somewhere in there. And I'll be 50 on August the 31st. So literally, half of my life or more, I've been watching markets. Well, how many trends and fads and bubbles and crashes do you think I've seen over 30 years or close to it? A lot. So I've got all that in my brain that I factor in, whereas a lot of people will isolate a certain scenario because of their inexperience. And if they've only been in markets for 5 or 10 years and they've just been in a cushy period of 5 or 10 years, they don't have a full picture of the full degree of risk and ramifications that can have happen. So, for instance, I remember people being in the NASDAQ tech bubble and internet bubble, and some people were quitting their jobs because they were a stock pro. They were making more money in their stocks than they were in their day job. All kinds of frenzy stuff happening, right? Here's the problem. Anything that can boom will generally bust. And most people don't know the difference between a dip or a pullback and when the momentum has actually shifted and the tide has actually turned. And by the time that you are able to accurately point that out and it finally dawns on you that that's not a dip or a pullback, because some of the dips and pullbacks are severe corrections of quite a degree percentage-wise. By the time that you realize that, oh no, the tide has shifted, the trend is down, this is not a dip, it's too late and you have lost so much money it's not even funny. And that's how people got burned in the crash of 2000, the crash of 2008. And if you think you're not, if you think we're not in a bubble, right now you got another thing coming. Because here we are. So I'm going to go way back on this chart, and so you can see this is since 1980. Bubble, bubble, massive mega bubble. It's kind of on par with this one. In fact, it's probably, well, actually it's even longer because we are in the longest recorded bull market in U.S. history. So when you're towards the top of that thinking sounds right because you've had all this history that seems to justify your thinking, much like this did, not knowing this was coming, much like this did, not knowing this was coming. And here's how this works. Bubbles get started, they get working their way up, they start making a lot of headlines right in here. The investing public, gets in somewhere in here, rides it up, makes a ton of money, doesn't know when the momentum's going to switch, and by the time that they realize that something wasn't just a pullback or dip, they're down in this region over in here, and they've lost everything that they've gained and usually then some. And here in this one, the entire rally was done away with by its decline. These lows here went lower than these lows here. So anybody that had bought and held at any point in this rally here from 768 to 1576 lost it all when it went down to 666 here. So buy and hold forever, buy at any time, I'm not a believer in. If you people say, well, just buy stocks, they'll go up over time. They will one day. But what happens if you bought the S&P 500 at a state of overvaluation here in 1999? It would have taken you till probably 2013 to get positive on that money. Well, do you want to take 14 years to get to break even? And remember, you bought diversified. You bought over 500 companies, because in the S&P 500, there's like 503 or 504 stocks, very large, the biggest stocks in America. So you've bought large, you've bought big, you've bought diversified. How can anything bad happen? And that's the novice thinking. Well, because you have bear markets and you have severe corrections that happen, and they come at the time when the people are most complacent and least expecting it, such as a period like this. And those things tend to come when the price is stretched far away from its 200-week moving average. And I know that can happen and be that way for a little while. But the thing that I would also point out is, and this happens for a little while too, but it's all the warning signs, is that these things start losing momentum before the turn actually happens in a downturn most of the time. This one I mean, yeah, you could say this happened, but it doesn't draw your eye near as much. It's really more of this right there that draws your eye more. So you had a little time to be aware of that one. You had a ton of time to be aware of this one, and you've also had a ton of time to be aware of this one, because here's your momentum die down. And yeah, that sometimes does that when you're in the middle of a bull market, such as here, and it ends up being sideways to a correction lower. But remember, that's in the middle of a bull market. We've been in the longest one in U.S. history, one that started in 2009, and here we are in 2019, and high PEs, margin debt levels that are higher than the last two crashes, PEs that are on par with average PEs in the S&P 500 that are on par with previous crashes, extended technically that's on par with previous crashes, and declining MACD, declining RSI, which is on par with previous crashes. So it's like, how many warning signs do you need? The problem is that you're going to want to naturally be inclined to go with your emotion, because the greed factor up here is so great, just like the fear factor down here and down here is so great. The fear factor, the emotion, makes it to where if you're led by that emotion, you can't even fathom buying a stock here or buying a stock here. And the problem is here, and here, you can't fathom even selling a stock, because after all, the stock market's been going up, and in your opinion, therefore, it's going to keep going up. And that's a fallacy of logical thinking. Now, when I say you, that's the general investing public, and some of my subscribers still fall prey to that, but it's not for lack of teaching and lack of emphasis. It's just because they still choose, and it is a choice, to be emotionally led rather than to stay with logical investing. So that's why I called it the logical investor, because that's what we're going to stick with, and we're not going to be illogical or emotional investors. And sure, you can isolate periods of time where, oh well, if we'd done this would have worked better or whatever. But I'm telling you, when you analyze those types of methodologies over time, most of those people go broke. And so I'm not into fads. I'm not into what's sexy or what's hot. I'm not into what's making the news media or what, quote, everybody's buying. I'm into sustainability. I'm into your portfolio's lasting. I'm in for them gaining over time, and not only sustaining themselves but moving themselves forward, and gaining decent dividends along the way when we can. That's what I'm into. So this is not, if you want super high risk and super speculative and gambling and lack of stewardship, you can find that anywhere. I mean, it's everywhere. You can turn on TV, you can watch Fast Money on CNBC, you can watch Jim Cramer on CNBC, you can do all that for free. You can, most investing or trading newsletters out there are momentum based, meaning they're getting you into something high in hopes that it goes higher. And why not? There's no risk for them, because they're issuing that recommendation, and many times they're not in their own recommendations. And so if it goes down, they didn't lose money. But if that momentum continues, then they look like a rock star until they don't. And then their newsletter blows up, and then their subscribership goes down the tubes and what have you. I'm not into that kind of a deal. I don't need subscribers that bad that I need to dangle you over the fire of risk to get subscribers, or for you to think I'm a rock star or whatever. I don't need that. What I need is for you to be around for the long haul, for your assets to be around for the long haul, for us to make respectable market beating and especially inflation beating returns, because that's what in real life, you spend money and you need your money to outpace the costs of things going up. That's what you really need. Like people say, I need a market beating return. And while we do that, what you really need is an inflation beating return, because you're spending your money on stuff. So that might be cars, that might be bread, that may be milk, that may be eggs, you know, whatever it may be. Most things go up in life over time, and so your money just sitting idly without being invested, um, won't keep pace with that. Savings accounts alone won't keep pace with that. CDs won't keep pace with that. Treasuries sometimes will keep pace with that, but not always. And it's why Warren Buffett loves stocks. And by the way, it's also why he's not fully invested all the time and why he's always got a ton of cash on the sideline. So the thing you can't convince a novice investor many times to do is to hold cash, because they're stuck on their novice thinking. They're thinking, I'm not earning anything when I'm holding this in cash. I'm earning point such and such percent, and where's that going to get me? And that's novice thinking. Advanced thinking, pro thinking, is I'm holding this cash so that when there's massive corrections in my positions or the overall market, I can average down or take advantage of prices that nobody else without cash can take advantage of, so that it turbocharges the returns that I would have normally got. And instead of getting, an 8% return, I can get a 12 or a 20% return. And because I had that cash sitting on the sidelines, and yes, it earned a jack squat during the period that I had it, but that wasn't the purpose of it. If it earned 0%, I would still suggest the same thing, because there's a big difference between the returns of those that have cash that average down and those that are fully invested. And it's a thinking that you have to shake, because generally your broker encourages you to be fully invested. And why is that? Because there's two goals of a broker: assets in and retain those assets. And if you're fully invested, guess what? You're less likely to cash out and to take money out of that account. But if you've got a bunch of cash sitting there and it's not doing anything and doesn't have a purpose, and something happens and all of a sudden, you want a new car or you want to take a vacation or whatever, the easiest thing in the world to do is take cash from that brokerage account. After all, it's not assigned to any stock right now anyway, so you don't have to do anything but request a check. And so they don't prefer that, obviously, because they make money by taking in money and retaining money, right? Makes sense. So of course, and most brokers are horrible market timers, and they don't usually know how to value stocks and that sort of thing. And so they're just saying, well, you never know what the market's going to do. You can't time markets, and so you just might as well always stay invested. And the problem is, for people who are investing today in the S&P 500, or even for the last year or two, and they're buy and holders, they're going to end up losing their butts more than likely, because they're buying diversified, yes, but they're buying overvalued. And diversification does not help you if you are buying overvalued. So diversification helps you from individual corporate risk, as if if one or two or three whatever individual companies go down, you've got 497 other companies or whatever that didn't go bankrupt. That's what that diversification helps you with. But diversification does not prevent you from massive percentage losses, as we saw in that S&P 500 chart. Those two crashes, one was 40% roughly, and the other was roughly 60% crash. And so, and that was still being invested in the 500 largest companies in America. So, but it's like I said before, if I bought 100 houses in 2007, did it prevent me from the housing crash, as if I'd only owned one house? No, it didn't. As a matter of fact, it compounded the problem. So diversification has its place, but many people think, well, I'm in the S&P 500, so I mean, how bad can it get? Well, it can get so bad that the market correction can be 40 to 60%, but that's keeping in mind that doesn't mean you just lost 40 to 60%, because of wherever you got into the portfolio, you might have lost 80 or 100% of your gains, or depending on where you got into that investments. Anyway, enough of that. I've hit that for long enough, but I want to ingrain that within you, because it's you got to know that stuff, and I have to preach it more when we're at market toppy periods and overvaluation periods, than I even normally do otherwise. So again, we sold IBM. It's getting stretched on the daily, but it's what's happening on its weekly is an even bigger concern, because we're getting up into this pocket of resistance that has rejected the price the last 7 out of 10 years. Somewhere in that area. We're also at a top Bollinger Band when there's still not a strong, huge, upward momentum like this. It's been somewhat sideways here, even though for us it's not been sideways because we averaged down and then it came up, so we had good gains for us. But when you have a weekly Bollinger Band hit, and again, it could go higher. It doesn't mean it can't go higher. It could break out higher. It could go 155, 160, 165. That could happen. But it could also just as easily go back to 135. And that's what I don't want to see happen. And so investing is not about predicting the future. It's about valuations, buying at the right valuations, buying fundamentally strong, averaging down at strategic correct points, and taking profits when you want to retain those gains that you have today, because you do not know what tomorrow holds, and it could just as easily give all that back as it could advance further. So anyway, hope that's helpful to you. So let's go through our positions. We have, I talked about how platinum is cheap relative to gold, but gold has been breaking out as well. So that just means that platinum needs to do a lot of catch up, but it's likely getting closer time for it to break out. Also, with it being so historically cheap, cheaper than it's been in the last 40 years relative to gold, and gold is in its uptrend. So it remains to be seen whether gold will pull back lower before heading higher, or whether we've consolidated sideways and getting ready to shoot up and head to new highs. With the way that it's acted, it wouldn't surprise me if it just shoots up to new highs from here, especially with how overvalued the dollar is. But if it retracts a good bit before heading higher, I'm still bullish on that. It's still uptrend. It's still higher highs and higher lows. Moving average is still heading higher. RSI and MACD heading higher, and so forth. So I'm very bullish on gold no matter what it does near term. Of course, you just had Boris Johnson take over. There's still Brexit issues. The Bank of England held interest rates steady overnight because, again, of concerns of Brexit and this and that. And so it's caused a lot of volatility in the near term on FXB. It's hit a bottom Bollinger Band both on the daily and the weeklies. And so there's a good chance that pops higher fairly soon. This is getting close to, let me see, 117.24. So this has hit the region of its lows right in here. So this is so hair splitting. This could either still be in wave C or it could still be wave 2. By using the hard rules, this would be wave C. If it goes materially lower, it'll be without a doubt still wave C rather than it being C1, 2. If so, that just means we have waves 1 through 5 ahead of us, and we're not usually in for a fourth or fifth wave, and depending on how big an advancement in waves 1 or 3 are, we're usually out in one of those because of time issues. Because if you may make more waiting all the way through a wave 5, but that is also assuming your wave counts are correct. And also, by the time you make your return on wave 5 and you divide it by the time that you were invested in the stock, you may not have actually benefited yourself. It may have been better for you to take your profits while the momentum was riding higher in a shorter amount of time and roll those profits over into something else that has an equal chance to have a nice sizable up move. So, but British pound is one of the most major currencies of the world. It ain't going to zero. It ain't going nowhere. I know it's not proper English, but you know what I mean. Central banks, the top currencies that they hold, well, the first thing they hold is gold. After that, they hold dollars, and they hold euros, and they hold pounds. So those are the most liquid assets of currencies in the world, and so I'm very bullish on the pound long term, and I believe it will do very well. So I don't have the least little bit of concern for it. EWW, matter of fact, if you have not done any averaging on the British pound, obviously you can do that. And while I'm on that topic, at the bottom of each portfolio, you never have to guess. You never have to ask me whether you should or could average down, because it's not that I won't answer you. It's that it's already here for you. So if it's 4 a.m. in the morning and I'm sleeping and you're up and you're wondering, hey, should I average down on something? I've got a whole averaging down point column right here. So on our newest PPLT, we just got into it, and matter of fact, I need to update this because I just updated our other thing. Hang on a second. So here's the updated version. 80.27 is what we got into it at, and you probably can't see this, with the print and the size, but we follow PPLT over to the averaging down points column. And where would Sean say to average down? So first entry is 80.27 is what we got in at. Anything at or below 83 is fine, although as low as possible the better. And right now it's much lower than that. But where would Sean say to average down? If he could talk to you at any time, 24 hours a day, he would say average down at the 75 level, average down at the 67 level. Sometimes they're very definitive points because of support or resistances or ranges, not ranges, but percentages differences. Sometimes they are ranges that will vary slightly. 42 to 44 range, 32 to 35 range. That means I'm fine with you averaging down anywhere within that range that you see that's in that range. And there's no assurity that it goes to the bottom of a range. Keep that in mind. So if it's at 34 on this particular position, and you see that that the range is 32 to 35, you may want to go ahead and average down at that point, because you don't know if 32 is coming. And if you miss it and it shoots from 34 back to 38 or 9 pretty quickly, you're going to be kicking yourself when you could have locked in a lower average break-even price that was presented to you at the moment. And again, a lot of people get greedy and they want to try to wait and squeeze out the last nickel out of something, and it'll bite you more times than not when you're trying to squeeze out the last little bit on the downside on an averaging, waiting for lower and lower and lower prices, and it'll bite you in the butt over time, trying to squeeze out that last nickel on the top as well. Whether you're trying to squeeze out for an exact percentage amount, which you shouldn't do, or an exact number, when it's time to exit. So, and I give you sell signals on that, or anytime you have an outsized return. Like even before we got our sell signal on IBM, some of you that had averaged down quite a bit were reporting, 20 or 30% returns on that. Well, should you lock that in? Yes, because you know that you have 20 to 30% today. You don't know that you're going to have 20 or 30% tomorrow. And what is an average gain in the market? An average gain in the stock market over time is usually 7 to 9%. Some people will say it's higher, but it's usually not. And so if you've got a 20 or 30% return, you're beating the market twofold over easily. So, so should that be locked in and captured? In my opinion, yes. So, because you know what you have in hand today, you don't know what you have in hand tomorrow. If some kind of breach or lawsuit or missed earnings or some kind of stupid stuff like analyst downgrades or whatever happens, and enough investors foolishly think enough of it and sell, you can have that, a stock tank a lot percentage wise, literally in a day. So, when I don't want to see you have 20% gain today and dilly-dally around on it, and all of a sudden something happens, and a day from now or a week from now, that gain is only 10%. So when the moment is there and you have outsized gains, take them. So anyway, and again, the averaging down points are down in the portfolio section at the bottom of each and every newsletter, so that you never have to guess whether you should average down or not. And if you buy at a price that is far lower than our entry price, because you got into it way later and found a more favorable price, then your averaging points will need to be at least minimally 10% between each other, between each averaging. So that's a general rule if you buy it at a point in price that's way different from when we bought into it. Okay, so EWW, this one's been in a sideways range for quite some time, for pretty much all of 2019, and I'm looking for that to break higher over time. So even if it breaks lower than higher, I'm looking for it to go higher over time, and I believe that it would do so. Again, it's been cheap PE, it's sound, it's been hated, it has all the makings, right? So GDX is one that we have been in, and we are up on, and I have on the next major push higher, we will likely sell that, but I wanted to wait until, let me go to the weekly, it'll be easier to show there. I believe it shouldn't have any problems getting up, around where this previous resistance and selling point is at a bare minimum. So we are up so much, and again, if you've had crazy gains on it, like again, some of you have said, hey, I'm up 31% on GDX, should I sell? My answer to you is yes. Why? Because it's an outsized gain that's like triple what the market would do. So it's like 3 years of market returns in a fairly short amount of time, because we bought this January 30th of 2018. So you might as well say 11 months in 1 year, and say 7 in another, so 18 months, so a year and a half. You've gained 3 years of market return. Should you sell? Yes. And you say, well, why would I sell if I got 31% if you think it's going to go higher? Because I think it's going to go higher. I don't emphatically know that it's going to go higher. I believe that it's going to go higher. Valuation-wise, it could go higher. Technical-wise, it could go higher. But nobody can wave that magic wand and say emphatically 3 months from now, 6 months from now, a year from now, whatever, it's emphatically for sure 100% made it to this level. So that's why if you are at those crazy returns, then you should consider selling. So I hope you're understanding the differentiation between what I believe something statistically has a massive likelihood of going to, but also by the same token, if you have some massive crazy gain today, why you should ensure that, because it's guaranteed what you have at the moment, that, versus what you may or may not have tomorrow, next week, next month, etc. So also the price is starting to get extended away from its moving averages. So just know that. But that can also happen sometimes with miners and with metals. It can go parabolic and not look back for a while. But we will probably, since we're metal heavy, but we're metal heavy for a reason, because I don't normally get us this many metals in this few of stock picks, but we are in a time when there are very few defensive assets to be held. I mean, you can't go out there and buy the typical defensive assets. Some people say, okay, well, McDonald's is a defensive stock. It's cheap fast food, and people eat there, and they'll keep eating there before they go anywhere else, even in bad times. But here's the problem. Look at the price relative to its 200-week moving average. So in a crash, this could easily go from 218 to 144 just to only get back to its 200-week moving average, and those in crashes tend to go far worse than that. People say, well, Walmart, everybody goes shop at Walmart. Everybody needs Walmart. I mean, or if they don't shop at Walmart in a recession, they will shop at Walmart. And while that may be true, it still doesn't mean that the stock can't be overvalued and it go from 116 to 79. And if in a bear market downtrend, it may go far lower than that. So what if it went to 116 to 45? Well, that wasn't defensive or protective for you, was it? So there's all kinds of, people say, all right, let's go to, Dollar General, same thing. Dollar Tree, another defensive one, same thing. Matter of fact, this one is already starting a lot of its correction. Went from 116 to 80, went from 113 to 96, with probably a heck of a lot more to go because that's dying off there and there. So this one's already probably starting to tumble. And all these defensive stocks has already been run up right along with the market. So there is no value in your typical defensive stock that normally nobody would find sexy and nobody would normally be invested in. They've already run up most of the defensive assets along with the momentum assets. So in fact, the defensive assets in this case have become momentum assets as well. So it's almost the everything bubble with the exception of very, very few assets. Commodities aren't overvalued, emerging markets aren't overvalued, metals aren't overvalued, mining stocks aren't overvalued, and a select few of value stocks, which we already hold in our portfolio or have recently taken profits off of on. So that's one of the reasons why we're metal heavy. We're metal heavy because you got the S&P 500 at some of the at the highest levels that it's been at, and when things crash lower, metals benefit from that, and so PPLT is at some of the lowest levels that it's been in the last 9 or 10 years, and so 9 years on this chart for PPLT, and platinum has been it's some of the lowest prices that it's been long before this ETF even existed. So but we're starting to see firming up in the RSI and MACD. We are seeing that in platinum itself, it broke a 8-year downtrend, and in PPLT, we're seeing it doing that as well. We're seeing selling volume drop off in the ETF, and we're also seeing it in the underlying. So there's all kinds of reasons why I believe that it is time to get into platinum, but it's undervalued, and it's been down for many, many, many years, just like the stock market has been up for many, many, many years. So it's a very contrarian play, and there's very few of them that are to be had out there, and we're in one of those right now. So EWW because I'm bullish on emerging markets, GDX because I'm bullish on miners, LPL. Again, this one's having some turbulence near term because there's issues between South Korea and Japan. There's issues with global slowdown, etc. But you just have to know the characteristics of this company. This company is known for massive slide offs before it gets its rallies upward. It doesn't. Some of them are kind of trickle down before they get their spikes higher. But these massive slide downs are not uncommon. You've got a big one here, but your bigger one here. Obviously, you have some volatility along the way. These are not as big, but it shows how big they can be from top to bottom. So why should I think it unusual that it's doing this when it's for the last decade it's done this, and then it was no reflection of what it did in the future, because you had this before that, you had this after that, you had this after that, you had this after that, and what comes after this? I believe something way up here probably is likely, but I believe something just above that 200-week moving average is an easy one to target. And so if you have averaged down, let's say from 13s and 10s and 7s or 6s or whatever, by the time you get to 12 or so, your average return is great. So you don't even have to even get back to your original entry price to make a decent return on that. And by the way, you've got your MACD so far as getting higher. Your selling volume is still getting less. your RSI is a little higher as well. The price is far away from the 200-week moving average. So there's a lot of reasons why we're likely near the next snapback higher. Also, it's at the weekly and daily bottom Bollinger Band, which is another thing that's showing that near term it's likely overdone and potentially ready to snap back. So, by the way, for those who are buyers of options or buyers of debit spreads, switching over to putting on my option cap here, when you can find something that is a solid company, it's got to be solid fundamentally and cheap fundamentally, and when it's both at a weekly and daily bottom Bollinger Band with diverging technicals, if you buy far enough out in time, which is minimally 6 months, I usually go 9 months to a year out, and you're buying something slightly in the money, there's an enormous chance of snapback of that, and you get several stocks that are like that, and you also have the ability to do, like I talk about in one of the options reports, where you don't necessarily go all in with all of your lots at one price, but if it were to head lower, you could do an averaging and an averaging to where you've got your full amount of what you'd put on, and then as it snaps back, your average gain on those options is so great. So you can use that with options as well. So there's a little nugget there, and that's not a recommendation necessarily to say, hey, Sean said buy options on LPL. I'm not saying that. I haven't even looked on to see if there even are options on LPL, much less that. But that's the scenario on the chart that you would want to look for. And we do have a few stocks that are in that scenario right now where they've had those large pullbacks. And so anyway, it's something to keep in mind. BBBY is one of those. It's had a sizable pullback on both daily and weekly chart. It is back at bottom Bollinger Band on the weekly and also on the daily. Weekly bottom Bollinger Band is much more of a bigger deal. Selling volume went up here, starting to go down here. MACD heading higher here, oversold on the RSI here. Selling volume still dropping off here. MACD firming up here, RSI increasing here. Those are the type scenarios that I'm referring to with the options, why I believe that it will snap back both for the stock and for an option. And again, I haven't looked to see if they have options on it. I haven't looked to see if there are liquid options on it. There's all kinds of stuff you have to look at yourself. But those are the types of scenarios, no matter what the name of the stock or company is, just how the chart looks as to what you would want to potentially get into using that type of technique. So again, very bullish on BBVY. I believe it would do very well over time, and you should have your final averaging in. If you don't, you should get it in. CAJ, has had a major run up and then a major pullback. We are in a major three-wave pullback that is, likely close to its end. It is in a bottom Bollinger Band on the daily. We are also at one on the weekly, with this still heading up higher over time, which is a more bullish scenario than if the longer term trend were still downward. So that's more bullish. Selling volume dying off. MACD and RSI overall heading higher. You've got your selling volume continuing. These spikes continue to die off here. Your MACD histogram is flattening out, so you're probably getting a little closer to a buy signal there. RSI is slightly higher there, so I'm looking for a snapback for CAJ as well. So again, very bullish on that. We just sold IBM and talked about it, so we'll go into KHC. KHC is perking up some. There's starting to be some more buying in it. How do we know? Because just in the very, very near term, we've got a high, a higher low, and a higher high. Again, in a higher high here than here in the near term, and it is flirting with the high side of a 5-month range. MACD firming up, RSI firming up, selling volume has dropped big time. So sooner or later, I'm looking for this to break above this range and start heading higher. Again, that might be sometime near term, or it might be a head fake near term pullback and then do it upon a future advance. But very bullish and very confident on KHC. Then we've got ticker symbol E, which is ENI. Again, we've got a pullback here. So far, this low is still higher than this low or this low. Selling volume keeps dropping off. MACD keeps picking up. RSI is deeply oversold. On the weekly chart, you've got in an overall major uptrend, close to its 200-week moving average, close to its lower Bollinger Band. MACD firming, RSI firming. So this is, even the type of chart that you would look for in an options consideration as well. Very bullish on that. SLV, this one had a pop big time into a higher high than what we had here. So higher high, higher low, higher high. So this low was higher than this low. So that's an uptrend. You got your golden cross. You got a very massively strong move. But just know, 13s to 1559, almost a straight move up. Of course, it needed a pullback. Now, is this the bottom and we go higher from here, or does it go further back and then go higher? We don't know. But we do know that the selling volume is more muted. The buying's picking up. So, the RSI is strengthening. We are temporarily at a MACD sell signal, but that may have been accounting for this move here and may be done with. Who knows? It could open back up or flatten out and turn back up. So, but what we do know is that gold has broken out to a new uptrend, and so actually, and I referred to this in the newsletter, palladium was the first one to have its first run up, and that run is likely probably over and getting ready to crash back downward. Look at how far the price is away from its 200-week moving average. So it got kind of in a bubble and got ahead of itself. Then gold has broken out into new highs, 136.63 here on the high here versus 129s and 131s here. So that's notably higher. Also, this major low higher here at 111, higher than the 107 and 100 that we've got here. So here's your ABC downtrend, and here's your next uptrend out of that. So gold is heading into a new uptrend. Silver hasn't confirmed that it is in. Silver is likely in a wave 3, and this can probably be seen easiest when I go to log mode. Yeah. This is likely ABC 1, 2, and then probably in the early stages of wave 3, because when wave 2 is confirmed broken, then you're typically have confirmation you're in wave 3, and we've done that. So as soon as it gets above the 200-week moving average, it should even head much higher. Now it could have quite a bit of a pullback before it does that, but 1311 is higher than 1304, so that's why this is likely wave 1, 2, and then heading into 3. We are temporarily overbought, but sometimes in breakouts that can happen. MACD is firming up, so liking what I'm seeing there. I believe we've got quite a bit more to go on silver, and we could return to this 1971 area and then some on that. So very bullish on it. And so I do expect, keep in mind, since I'm expecting a stock market sell-off, I am expecting some pullbacks in some of our positions that will pull back along with the market. But what does that do? That gives us averaging down opportunities to get an even higher overall return in the future because we've got cash deployed. And in the interim, we don't just have to be subject to the market, what I believe will be the market decline, because we also have value defensive plays that are some of the very few defensive plays that are out there. GLD, GDX, SLV, and PPLT. Those can all prosper and profit while the market is in a decline. And some of those are even starting to profit now as institutions roll into those assets in anticipation of the decline due to such overvaluation and complacency in the overall market. So again, very bullish on SLV. And I believe we'll do very well on that. CHL is one that if you haven't averaged down on, you should consider averaging down on. Yes, this will be one that we exit sooner than than many, but by the time we get a little past break even and exit that one, you'll have still been nicely profitable if you average down, because we got in at 47.75. So if you get in at 47s and then you get in at 42s or 43s, you average that and then you get back out just a hair above break even of your original entry price, 47.75, then you still made, a pretty decent return and probably what may end up being a fairly short-term gain. So for its holding time period, you could still end up having a decent return relative to the holding period. So that's why it's solid fundamentally. Huge company, doesn't have debt. It's got a larger customer base, and we even have people here in America. Oversold on the daily. MACD firming up. Selling volume is heading lower, not higher. So it's another sign that the downward momentum is likely limited. Also, we're at a bottom Bollinger Band there. We're practically at a bottom Bollinger Band here on CHL as well. So MACD firming up some, selling volume dropping here, oversold with a slight angle up there. So bullish there on CHL, and then again, I believe PPLT will do great, which is our latest one, which we've already talked about. So I believe we're greatly positioned. Again, keep in mind, and I know some of you are thinking Sean's more on his game, but because we've now had 6 positions sold in a small amount of time of holding them, 3 weeks, 3 months, 6 months, 5 months, 1.5 years, and 9 months on IBM for those who hold it in LI, logical investor, and bought it and held it there. So, but that's keep in mind there's a bell curve, right? And when you look at investment returns over time, they'll kind of fall within that bell curve. There will be some part that'll be on the left tail, which is the those quick returns, and that's quick for investing. A year and a half to 3 weeks, that range, that's quick. And the 3 week thing, that's an anomaly. That that may never happen again, but it did happen. And then there will have some on the other extreme tail that could be longer. That could be 5 years or so. And then we will have the bulk of them, which will likely fall in the 2 to 4 year window. One thing I will say for you is that many of you are probably going to be having a lot better returns and bigger returns in LI than you ever did in UWR or AP, which are 2 of my previous newsletters for those that are new, but only because you have gotten the rock solid concept of averaging down. So I've mentioned it relentlessly in the last newsletter, but because of the format of the last newsletter, you couldn't interact with me directly. You couldn't ask me any direct questions. Communication was only one way from me to you through my newsletter and through my video, and you couldn't come back and ask me questions. You couldn't learn from others in the community. You couldn't learn from the answers to other people's questions. All of that you've been able to do in this. And also I can put anything in my newsletter I want and it doesn't get cut out, which that's never happened before. And that helps you a lot because I put in pertinent stuff. Sometimes it gets cut out due to space and time constraints or whatever for the previous publishers. And I can say anything I want to in my weekly videos, and that's kosher as well. So because of all that, you have gotten a better understanding of my full strategy, and therefore you've gotten better results. And so for many of you, because you are averaging down now, not only will you find that you're getting greater percentage returns, but you're also going to find that on average it's going to shorten to some degree your average length of holding time in that investment as well. And so for some of you that held stuff for 4 or 5 years, in previous portfolios, had you gotten the concept of averaging down good, that could have been reduced to 2 or 3 years or something like that. Which again, for investing, true investing is over years. If you go to your broker and say, "Hey, I want to invest money," if they're any good, they'll say, hey, don't invest money that you can't leave for 5 to 10 years, because that's a typical investing time horizon. Our average time holding period is 2 to 4 years. Sorry, I had to pause that. My robot vacuum cleaner just got through charging again and is resuming its the vacuuming of my floors. If you never had one of those, they're awesome. I've got one of the, it's called Neato, Neato. Neato, I forget what model it is, but it's one of the ones that does a bigger footprint, a bigger amount of square footage. Not that I have to have that bigger square footage, but I want to be able to do more than that. Anyway, if you've never seen those things in action, my wife hasn't had to do, nor me either, major vacuuming jobs because of that Neato vacuum cleaner. So it's an amazing thing. They're not cheap, but once you have one and you get to use them, it saves you so much manpower, so much of your back. And it helps, whatever spouse tends to do more of that work, it helps tremendously. So anyway, I'm not a Roomba fan or whatever. It's round and it doesn't get to the corners as good. It doesn't suck up stuff as good. The Neato does better than any of those that I've seen. But anyway, I don't get paid for anything off the Neato. That's just something that happened to come up because my vacuum cleaner started back on its vacuuming cycle again. So anyway, so again, I'm very bullish on these positions. I believe that you will do well in them as you average down and have patience over time and see those through. They're very solid assets and will do quite well over time. And in the meantime, though, we're just not subject to the market crashing or correcting severely, deploying cash, and then only making gains after that heads up. We are also at the same time in assets strategically positioned to where we can benefit and gain on those in the interim while we're waiting on this other stuff to pull back and to head higher. So all these metal positions are prime examples of those that can profit greatly in market-beating returns while the overall stock market could be in a full-blown bear market. So while investors are losing their butt, outside of LI, you can be doing quite well in those metals positions, and us booking profits, massive profits off of those, which can even give us more cash for more averaging down as the market corrects further. So it's very strategic how I've got things set up. So that's why I say don't tweak the system. Don't say, well, I know Sean said to get out here, but I'm going to wait for this. Or I know he said to average down in this range, but I'm going to wait for this. Or I know he said to only do this, but I'm doing this. Please stick to what I tell you, because I've got 20-something years of trying to figure all this stuff out. I didn't just start doing this yesterday or 5 years ago. There's a rhyme and a reason to every single thing that I tell you to do. So it's not that, oh gosh, Sean just wants us to follow him robotically or whatever, and just listen and hang on every word. It's not. I promise you, it's not for ego's sake. It is for take everything that's taken me forever to learn, and you benefit from that and crunch that time, and you benefit from my knowledge in a fraction of the time that it took me to learn. That's a lot of what you're paying for. Yes, you're paying for picks. Yes, you're paying for returns, but you're also paying for the massively crunching of time and massively expanding your experience at an exponential level than what you normally would have done had you just been out there on your own. And what's that going to do? It's going to change you. It's going to change your thinking. It's going to change your pocketbook. It's going to change what you can leave to your lineage. It's going to change what you can give to your church. It's going to change what you can give to the needy. It's going to change your whole world in so many ways, and so many other people's. And so this will have a ripple effect that we will only know one day when we're all sitting in heaven talking about this stuff. But on this side, we won't even collectively know, but we know that it will be huge. So anyway, thank you so much for watching and listening. I thank you for sticking with me through the transition to the new website. Like I said in the newsletter, please be patient. It will be in beta mode once it's up. There will be bugs, there will be hiccups. We will need to fix stuff. It won't have full functionality from day one. There will be a process over time of certain functions that we have now that will be built out over time. So just please be patient with that process. but I believe that it'll be more than worth your patience, more than worth your time, and more than worth your money to come over there with us. So thank you so much for watching and listening, and God bless. Bye-bye.